Hi, I'm Andrew Allred, Vice President with Four Bridges Capital Advisors. Thank you for tuning in today to part 13 of our video series on a guide to selling your business. Today, we'll be talking about net working capital, also referred to as working capital, and often abbreviated as NWC for net working capital. Before we start talking through working capital, let's zoom out and ask, how does a buyer value a business? Let's look at this simple formula. EBITDA times a multiple equals the enterprise value. Why EBITDA? Well, EBITDA is a capital structure neutral metric. EBITDA does not care if the owner financed or outright purchased equipment with cash. It's before interest and excludes principal payments. EBITDA doesn't care about the tax rate. It's capital structure neutral. Therefore, enterprise value itself is capital structure neutral. It represents the total value of a company's operations, taking into account both equity and debt, making it suitable for comparing companies with different financing structures when used in valuation analysis. So, to get from enterprise value to equity, we need to subtract debt and add cash. Or said differently, enterprise value is equity plus debt minus cash. Now that we've expanded our initial question, let's ask another question. What is a buyer actually buying? Before we answer this, let's write down the classic accounting formula. Assets equal liabilities plus equity. Now, let's break this down into its components. Assets include cash, current assets, and long-term assets. Liabilities include current liabilities and long-term liabilities, like debt, and you're left with equity. So when we asked what is a buyer really buying, well, they're buying an ownership interest or the equity. So let's link our two formulas here. Now that we've done so and connected our formulas, let's drill in a little bit further. If I am a buyer and I'm paying a multiple of EBITDA in order to own a business, I need everything that generates the EBITDA to come with the deal. So what does generate the EBITDA? Well, let's look back at our formula. Of course, the people, but let's tether the question to the formula itself. We can quickly eliminate cash. Let's cross that out. Technically, yes, cash can be used for purchasing inventory, buying equipment, etc., but we don't have to use cash. We could have zero cash and fund those purchases with debt instead. The same goes for long-term liabilities. Yes, debt can be used to make purchases, but we also could have used cash instead. So let's cross that out as well. If I'm a buyer, I will say that I need the long-term assets, the trucks, the equipment, etc. I'm buying those as well when I pay a multiple on the EBITDA. Same for current assets. I need the inventory, that turns into sales, and the accounts receivable. That's the result of sales to support an ongoing EBITDA. The same is true on the other side of the equation for current liabilities. I need those accounts payable. That's how I'm funding purchases to support an ongoing EBITDA. Now, equipment, trucks, etc., the long-term assets that we left in the formula are physical assets, not working capital. So let's cross that out. What we're left with, current assets and current liabilities, are the components of working capital. So let's break those two down further. Current assets are comprised of accounts receivable, inventory, and prepaid expenses. On the other side, current liabilities include accounts payable, accrued payroll, and other accrued expenses. So why does this all matter if you are a seller? Ultimately, the working capital, current assets minus current liabilities, will be compared to a target. The target is simply an average of working capital over a period of time, most often 12 months, but this is a negotiated point and can range from 3, 6, 9, or 12 months. The comparison of working capital at closing to target working capital equals the purchase price adjustment. It gets even more complicated in that typically there's a 60 to 90 day period in which the working capital estimate is retabulated to a final working capital balance and then compared to the target to true up the original purchase price adjustment. Then the question, of course, is this a meaningful dollar amount? We often see that this can swing value by as much as 10% from seller to buyer or vice versa. You may think I can handle this, but you should consider that most of the time the buyer is a sophisticated deal expert. They do deals all day, every day. They've negotiated working capital calculations, targets, and true-ups hundreds of times, and they want the adjustment to be favorable to them. We've only scratched the surface today with this short video on working capital, But I hope that the takeaway is please don't try to do this on your own. Please hire a trusted advisor to negotiate on your behalf. Thanks for tuning in and listening to this short video on working capital, and thanks for staying tuned in our video series.